An investor got Dominican citizenship by buying a property for $200,000. When he tried to sell, the developer offered him $80,000, 60% of his investment gone. And this is just how the system works. The old investing adage is true: plan the exit before the entry. In this video, we're going to show you what happens when you try to exit citizenship by investment real estate in the three major markets: the Caribbean, Turkey, and Egypt. We'll walk through real transaction data, structural problems with these programs, and how to identify issues before you invest hundreds of thousands of non-refundable capital. Let's start with the Caribbean. 5 countries offer citizenship through real estate: St. Kitts and Nevis, Antigua and Barbuda, Dominica, Grenada, and St. Lucia. Caribbean citizenship-eligible investment real estate come in 2 forms: titled properties, where you actually own real estate, and preferred shares in resort developments, where you own a piece of paper representing part of a hotel project. Both face the same fundamental problem. When you try to sell, your buyer pool consists almost entirely of other people shopping for citizenship. Regular real estate investors typically aren't interested. Tourists aren't buying. Local buyers can't afford these prices. You're selling to future CBI applicants, and really that's it. Think about what that means for pricing. If someone wants citizenship and can buy fresh developer inventory at the $200,000 program minimum, why would they pay you $250,000 for your used investment? They won't, frankly. Unless your property offers something genuinely exceptional, you're competing against developers who have better marketing, established sales channels, and brand new units. The holding periods make this worse. Antigua and Barbuda locks you in for 5 years. St. Kitts and Nevis stretches ownership requirements to 7 years. By the time you can legally sell, newer inventory has flooded the market. Your resale channels run through the same CBI advisors and developers who sold you the property in the first place. Advisors make commissions selling new developer inventory. They don't have an incentive to push your resale stock when they could earn more selling something fresh. Developers who offer buybacks need room for their own margin plus commissions on the next sale. That's why someone with a $200,000 share investment was offered $80,000 to exit. Shares get hit hardest because they're completely tied to CBI demand. They generate returns that lag basically every other investment you could make. No one holds them for any reason except citizenship. None of the 5 Caribbean CBI countries publishes official house price indices or transaction databases. Grenada gives you the best data through IMI and Terra Caribbean, which tracked 366 transactions worth about $143 million Eastern Caribbean dollars in the first half of 2025. But that's the exception. Caribbean CBI real estate delivers citizenship first, real estate second. Titled properties in strong tourism markets might appreciate, but the structural setup favors developers over individual investors trying to exit. Can you sell on the open market? Technically, yes. Is it probable? No. Is it impossible? Also no. It depends on the property, the location, and how much you're willing to lose. But don't pretend you're making a real estate investment. You're buying a passport with property attached. Now let's talk about Turkey, where the contrast is striking. Turkey's real estate market runs with transparency you rarely see in emerging economies. The central bank publishes detailed residential property price indices that track performance across regions and time periods. December 2025 data showed national prices up 29% year over year in nominal Turkish lira terms. But real inflation-adjusted returns dropped 1.4%. Istanbul residential prices climbed 28.5% nominally, while slipping slightly month over month. Currency and inflation matter here because of the way the citizenship by investment program works. Turkey recorded 1.7 million house sales in 2025, up 14.3% from the previous year. Istanbul alone moved 280,000 units. Compare that to Caribbean markets, where your entire buyer pool is a few hundred citizenship by investment applicants per year. Comparatively, Turkey has a liquid market with depth. Foreign buyers remain a small but consistent chunk of the market. They purchased about 21,500 properties nationally in 2025, with roughly 8,000 of those in Istanbul. All in all, foreign purchases make up about 1.3% of total market activity. Turkish law says properties already used to qualify for citizenship can't be recycled for the next CBI applicant. Sounds like a problem, right? In practice, it does not matter greatly. Citizenship applicants represent roughly 1.3% of all purchases in Turkey. Cutting them out of your potential buyer pool removes a tiny slice of an already small segment. You're still selling to 98.7% of the market. Turkish CBI-eligible property behaves like Turkish real estate that just so happens to qualify for citizenship. Resale follows normal market patterns, and neighborhood quality, macro conditions, and currency movements drive what happens to your money. You might make or lose money, but at least you're playing the same game as everyone else buying real estate in the country. The real risk here is currency. Nominal gains in Turkish lira can deliver strong returns when the lira holds steady against the dollar, but exchange rate swings can multiply or wipe out your local price gains. Finally, let's look at the final large citizenship by investment market, Egypt. Egypt's housing market runs hot with supply and transactions activity that makes Caribbean volumes look microscopic. Cairo delivered 32,000 homes in 2025, up 34% from the previous year. Knight Frank projects roughly 100,000 units coming in 2028. The new administrative capital's R7 district alone completed around 7,500 units in a single quarter. The market's energy comes from domestic demand that exceeds supply. Egyptian banks offer aggressive leverage, and getting a loan is relatively straightforward. That keeps properties moving quickly. Price things right, and you can flip fast. But this is interesting. Egypt's citizenship by investment program barely registers in real estate, despite competitive pricing. Developers don't need CBI buyers to move inventory. Local demand runs the show. Commissions for citizenship-linked sales are minimal because developers can sell to Egyptians without the extra paperwork. Egypt opened its citizenship program to all real estate inventory in September 2023, after previously limiting it to government-administered properties. But that didn't change the fundamental dynamics. Egyptian CBI-eligible property functions as normal real estate in a supply-heavy market. Citizenship qualification adds nothing special and creates no constraints. Properties go up or down based on location, development quality, timing, and broader economic conditions. The biggest factor for foreign investors is currency, just like in Turkey. So before you wire money for any CBI property, ask yourself, if citizenship wasn't part of this deal, would I still buy this property at this price in this market? If the answer is no, consider whether that citizenship is worth a total loss in property value. Plus, remember that most of these aforementioned citizenship by investment programs have alternative investment options: donations, public market investments, bank deposits, etc. You're buying a passport, price it accordingly. If you're interested in purchasing real estate in a foreign country, particularly for the benefit of a second residency and even citizenship, you may want to consider Panama's Golden Visa with minimal stay requirements. IMI Pro and industry expert Mikhail Thorup talks all about your options in the video on your screen now. Subscribe and see you in the next one.